Yes, sir. Good afternoon.
Okay. So, so last week we covered, let me share my screen. So we covered foreign exchange risk, foreign currency futures, forward exchange contracts. We came all the way to liquidity risk. We covered a bit of that as well. So, any questions before we start today's topic? Any questions on what we have covered so far? Okay, so no questions. That's fine. Mm. Forward exchange contracts. We covered so liquidity risk. So we discussed earlier on why liquidity risk is so important to financial institutions. Can one of you give me an answer as to why liquidity risk is so important? Can we? Exactly. Simple as that. So, is can a bank have liquidity issues whilst being profitable? If I ask you that question, can a profit-making bank or a financial institution face liquidity issues?
Yeah.
Yes, exactly. It can, because profit and liquidity are not related. They are two different aspects. Profit is basically making more money than your costs, whilst liquidity is the amount of cash or equivalent liquid assets that you have in hand. Uh, Also, it's because of this the sensitivity of it and the importance of it, which is why central banks and other monetary authorities specify the parameters. You need to, if you have this amount of deposits, you need to keep this amount of liquid reserves, and the kind of reserves you can keep, what constitutes as liquid, what can you categorize as liquid, and so on, right? So this is a very important topic, and for those of you who are working in financial institutions, whether be it a bank or any finance company or whatever, this is very important to you, and more often than not, this would be something that you would be covering on a uh, day-to-day basis. Right. So let's continue with the liquidity risk. Yeah. Yeah. So there isn't a futures market in Sri Lanka. So the only thing that you can do is to enter into a forward contract. Okay. So banks. So
So
if you
why?
take export, yeah.
Sorry,
Go
sir.
ahead.
Why
Go
are
ahead.
there any other derivatives like that, sir? Like futures, options, and things like that in Sri Lanka?
Yeah. Okay. So first thing is Sri Lanka is a small country. 80 billion economy. So out of that 80 billion, also it's only the exporters and the importers who use this particular product, foreign exchange product, right? So out of the 80 billion, I don't know how much, 20 or 30 billion. Okay. And so because of that, basically there isn't a demand for it. And and if you look at the if you look at the activities of treasuries, these treasuries are also not, they are not very proactive. They prefer to take a very easy approach to this entire process. So like exporters, they, it's not like they look into the forward market or they do a lot of analysis on how exchange rates are going to go, etc. It's, they rely on the banks to guide them. Other thing is to have a futures market. It's quite costly. You need to have a futures exchange. You need to have a regulator for it. You need to have banks need to quote for it. So right now, it does not really make any sense to have a futures market to be there. Now you mentioned options, derivatives. So there was a derivative market, a very budding or growing derivative market long years back. Maybe you would have heard of the CPC oil hedge. So that oil hedge is the most famous derivative transaction in Sri Lankan history. And as you know, it ended in a fiasco. So now this is where, law and the implementation of law overlaps finance. So now to give you a brief background on what happened to CPC, so they hedged their foreign exchange risk. Sorry, no, they did not hedge their. They did two things. They hedged their foreign exchange risk. Also, CPC hedged their commodity risk, both the oil price risk and the forex risk. So after doing that, when the government, when the prices went the opposite way and the government had to pay the banks, the government defaulted on the payment. So that is the long and short of it. Now, when the government does something like this, defaults on this, and the Supreme Court also upholds the decision that the government took, it sets a bad precedent for the banks. Why would a bank go and offer a derivative product when when it goes wrong? It's very likely that the other party will not repay you, and even if you go and ask the courts for justice, something might happen like this way. So uh, simply banks stopped quoting derivative products. Simple as that. Because I mean, why? I mean, we do all the banks. I mean, all banks, all businesses work for money, and there's no reason, right, to enter into, even if it's a lucrative business where there is a chance that your payment may not happen. There is no reason at all to enter into it, right? So basically, this is what happened.
So you said
So
that
anyway,
sorry, you said that the oil, the CPC had a hedging arrangement, right, sir?
yeah,
So, like strategies of hedging is using options and futures, those kind of derivatives, isn't it, sir?
yeah. So hedging, to hedge, you can use forwards, futures, options, all of that. So in this particular case, they used Uh, options. So
Or
they use the leverage option. So that's why that's what caused the loss to be multiplied and amplified. So yeah, so that's what
all right.
happened there.
Okay, sir. Thank you.
So and also in financial markets, it's a uh, something that you need to remember in financial markets and banking is that if something is too good to be true, then it is normally not, it's not something genuine. So I mean, you can't have a free lunch in finance. You can't feel that okay, I can go and unless you have a very specific uh, view on a foreign exchange and it turns out right, or it goes it's very hard for you to take, if you're like trading options, which is something like what happened with the case of CPC at zero cost. It's very unlikely that you will be able to do things at zero cost. Okay, so it's like a rule of thumb that you can keep in mind.
Thank you, sir.
No worries. So any other questions? No questions. Okay, so funding liquidity risk is the risk that a firm will not be able to meet its current and future cash flow and collateral needs, both expected and unexpected, without materially affecting its daily operations or overall financial condition. So, financial firms are especially sensitive to funding liquidity risk since debt maturity transformations, for example, funding longer term loans or asset purchases with shorter term deposits or debt obligations is one of their key business areas. Okay, so let's look at this through an example. I'm going to put some things on the chat here. Okay, so this is the first day the bank is operating. So so let's say it raises 10 billion of deposits in 3-month FD. So it goes and raises 10 billion of deposits as 3-month FDs. Okay. Now on the how will the balance sheet look like? Is this asset or a liability? Can someone tell me?
Reliability.
It's a liability. So liability side we have 10 billion 3-month FD. Now using these liabilities we can go and create assets. Now what do we do with that? So what are the type of assets we can create? We can go and create overdrafts. We can go and create term loans, working capital loans, housing loans, project finance to corporates, or we can go and invest in Sri Lanka government treasury bills, bonds, debentures of other banks, other corporates, etc. Okay. Now let's go and check. Now, if we go and invest in the entire 10 billion we have borrowed or taken a deposit as, we are going to go and lend it as 15-year housing loans. Housing loans. Okay. So this is the asset. So when it is 15 years, let's assume that it's monthly amortizing. What does monthly amortizing mean? So 12, that is the amount of months per year, 12 into 15. In that uh, number of months, both the interest and the what you call principal gets repaid. So the principal gets divided. So there are different ways by which principal amortization happens. So let's assume the principal is amortized on a equal basis. So 12 into 15, that number, you divide it by the principal amount. Using it, you divide the principal amount. So you get the per month principal amortization schedule. Okay. So that happens. Okay. Now you get these cash flows on a daily, on a monthly basis. Now we have gone and placed the FDs. We have gone and raised the FDs in 3 months. So at the end of 3 months, we have to repay the customers. So, but at the end of 3 months, we would have only gotten 3 cash flows from the assets. So, which is less than the total amount that we have lent. So, on one hand, on the liability side, we have to repay the entire liability book. We have to roll it over. But on the asset side, we have only got a fraction of the asset that we have created. Also, I'm assuming that there are no defaults. Hmm? There are no defaults. The asset book is fully dead. There is no non-performing assets on this. It's all good and so forth. So obviously, as you can see, this is not viable. It's not viable at all. Now, did you understand? Did you see how this works out? Yeah. Now, this is a good example of funding liquidity risk. So even if the bank goes and invests their liabilities in government securities, if there for some reason interest rates have gone up or there is a fear of a domestic debt restructure or something like that, and if the market, if there's illiquidity in the bond market, what do? There is pressure. The market immediately, you won't be able to de-risk and get the, or discount your treasury bill or treasury bond and get your cash back and repay your depositors. So that is a big problem. So did you understand what I just discussed here? Are there any questions regarding this? What 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 do what do you mean? Mm-hmm. Mm-hmm. Flexible. Yeah. Yeah. Okay. So now, no, that's fine. So 12. Now, how many months are there in 15 years? 180 months, no? 180 months. Okay. So now let's assume that to make the calculation easy, that there is no zero interest on the housing loan. Okay. Now 10 billion divided by 180. I have put 189 by 180 gives you the amount of principal repayment you get per month. How much is that? That is around 55 million rupees, right? Yes, 155. So in 3 months' time, how much money would the bank have collected? Only 166 million. Now, but the FD value is 10 billion. You saw that, right? So 10 billion versus 166 million. Because now the FDs you have to pay in full, right? Okay, you can always say, okay, now the entire FDs won't go out. But even if 10% of the 10 billion, that's 1 billion, right? You only have 160 billion in hand. What do you do? Correct? Right. So that's a good. Any other questions you would like to ask? Any other questions? No questions? Yeah. So it's like this now. This is an extreme case that I gave you. Obviously, it's very obvious now that you will never be able to meet your liquidity requirements in this case. Yeah. Yeah. So you have to. So the reason I gave this example is to tell you how this comes through. Okay. Did you get it? All right. Any other questions? Okay. No questions. Good. So going back to the note. You can see the note, right? Yeah. In response to this well-known risk, financial firms establish and maintain liquidity management systems to assess their prospective funding needs and ensure the funds are available at appropriate times. A key element of these systems is monitoring and assessing the firm's current and future debt obligations and planning for any unexpected funding needs. A key element of these systems is monitoring and assessing the firm's current and future debt obligations. So you have to keep on monitoring this. So as I told you, some aspects of this are very predictable. So like say during the April month, during our the season or during the Christmas season, or other Thai Pongal or Eid or Ramazan or any of these, any festival in Sri Lanka, when people buy goods or people go to their villages, there is a certain demand for cash. So most people will draw down their savings. So that is a very predictable demand for liquidity during those periods, and planning for any unexpected funding needs. So on top of that, you have to look out for unexpected funding needs that will happen out of the blue. So for example, if there is some kind of a credit event that is relevant to your bank or financial institution alone, or there is a credit event for everyone, for the entire system, or something. It could be anything, right? So if there is anything like that, this could happen. And those treasury people in that particular financial institution should be aware of this. More than anything, they should be aware. They should not be like sleeping and be in the dark about this entire thing. They should be aware, and they should go and take take proactive decisions to sort this out. uh, Regardless of whether they arise from firm specific factors, such as a drop in the firm's collateral value, or from systemic, which is economy wide factors. To balance its funding demand, both expected and unexpected, with available supply, a firm must also incorporate. Sorry, I missed that. Where is that? Must also incorporate its costs and profitability targets. Okay, right. So, any other questions on what we covered so far? Because we'll go slow, otherwise, you know, this will be. It's very. I don't know. This is very important, and you guys need to be following this. It's pointless rushing through this. Right. No questions. Good. Yeah. Go ahead. Yeah. Hmm. Yeah. Very good. So when the entire system needs liquidity, it's the central bank who comes and steps in. So how do they come and step in? They come and step in by using. So there is a separate department in central bank called the domestic operations or the open market operations department. So what they do is they add or withdraw liquidity as per the requirement in the market. So, for example, say the Urdu season, they will go and do some open market operations to withdraw, to add liquidity to the market. Whilst if it's in another situation where say they want to tighten monetary policy or reduce credit growth, during that situation, they will go and withdraw the liquidity available in the market. So that's how it works out. Okay. Uh, are you okay with that answer? Yeah. Yeah, so they can buy back T-bills, they can buy back bonds, or they can go and simply do this. They can go and have open market operation auctions. So OMO auctions where they inject liquidity either on an overnight basis or on a weekly basis or a monthly basis as they see fit. Yeah, they can do it accordingly. Exact. Yeah. So they are injecting the liquidity. So this is a liquidity injection. So it's like a temporary lending. That's what the central bank does. And when that happens, they will the basically banks have more cash with them to lend out and do whatever they want. Of course, there's a cost associated with that. So if it is low enough, it will result in liquidity improving. Because if the cost associated with the liquidity is too high, there's no point with it now, because banks will simply not borrow at all. Yeah, right. Financial firms can meet their liquidity needs through several sources, ranging from existing assets to debt obligations and equity. The most readily available is operating cash flows arising from interest and principal payments from existing assets, service fees, and the receipt of funds from various transactions. So, the most readily available or easily accessed is cash flows arising from interest and principal payments from existing assets, service fees, and receipt of funds from various transactions. For example, active management of the timing and maturity of firms' asset and liability conditions. Yeah. So that is how liquid. Yeah. Go ahead.
Yeah, we lost him for about a couple of minutes.
Yeah.
The slides.
Slides and
Okay. One second. Now, can you see me? Can you see the slides?
Yeah, now okay.
Okay. So this is, for example, active management of the timing of active management of the timing and maturity of firms' asset and liability cash flows can enhance liquidity. In addition, firms may sell assets that are near-term cash equivalents, such as government securities. It's typically done on a contingency basis to meet unexpected cash needs, and such liquidity reserves must be actively managed since the assets must be unencumbered, that is, not pledged as collateral for any other transaction, and easy to liquidate under potentially adverse market conditions. So, this is how the the liquidity reserves are managed. They are kept in, they are kept under uh, various under liquid reserves. So basically, as T bills, T bonds, or whatever. Okay, so that's how it is maintained. Right. Any questions on this? Any questions on what we covered so far? No questions? Okay. So now instead of selling government securities, an important alternative to an outright asset sale is an entry into a repurchase agreement. In such a repo transaction, the owner of an asset sells it to the buyer but also enters into a separate agreement to buy the asset back at a specified time for a set price. So it's like a, you mortgage something that you have for cash. So you give the asset as collateral and obtain financing against it. From a funding perspective, the repo provides us the seller with a short-term loan that is collateralized using the asset in question. The Central Bank of Sri Lanka's discount window standing lending facility is a venue for such repos based on specific asset types as collateral. Access to the discount window has historically been limited to depository institutions. So this is a description of how the repo window works and the kind of. So shall we discuss in more detail how a repo works? So I'll put the stuff on. Everybody can see the chat, right? Yes?
Yeah.
Yeah, all right. So now, so let's assume that this commercial bank, so they have 1 billion in T-bills. Okay. So to get access to this T-bills that they have, to this liquidity they have tied up in T-bills, they can do two things. First one is sell T-bill in market. So what happens? You give T-bill to bank or primary dealer. Bank or PD gives you cash. Okay. Or number two, you can repo the T-bill. So what does the repo mean? A repo is a exchange. You exchange. It's a lending. So you want to borrow some money from another counterparty. What do? You go and give this security as this T-bill as security or collateral, and in return, what do? You get, and in return, you get cash, right? You go and you get cash. So obviously, for that, you will get an interest as well. You have to pay an interest for the cash that you pay. So the total interest that is paid depends on the time period of the borrowing that you take, and also like the market interest rates during that time. So let's assume that this is for an overnight basis. Okay. So commercial bank goes and, let's say it goes and repos it with the central bank. So CBSL takes T-bill, 1 billion of T-bills into its custody and lends to commercial bank 1 billion, not 1 billion, less than 1 billion of cash. So next day, commercial bank pays amount borrowed plus interest. CBSL releases the T-bills held under custody. All right. So, so why did I use this? And lends to commercial bank less than 1 billion of cash. Why is a low amount of cash lent out? Can someone tell me? So if the security value is 1 billion, if the collateral value is 1 billion, why is less than 1 billion lent out? Any reason?
In case the interest rates move,
Okay.
the
Any other
value of
reason?
and the value of the collateral becomes less than the amount borrowed, so they want to keep that buffer.
Okay, that's a good one. A good point. Any other reasons? So see, if commercial bank defaults on this, what the central bank have to go and take over? It is the T-bill that they have taken custody. So the T-bill will give you only 1 billion. That is so this is a government security, no? It has a defined value. So it's not like a house or a car or something where it's dependent on market. So at the end of, even if central bank worst case they hold it till maturity, you will get 1 billion, nothing more than that, right? It's a defined product. So because of that, because the maturity value of this is established, you will only lend out a percentage of it, say 70% or 80% of it, because you have to account for the credit risk of the borrowing party. So in this case, it's the biggest commercial licensed commercial bank in Sri Lanka. So obviously it has very low risk, but still you have to keep some sort of a headroom to deal with, as you said, interest rate risk and also default risk. Okay. So this process is there for longer tenors as well. Say overnight, 1 week, 3 months, 1 year, any amount of time. These things can be done. Okay. Any questions on this?
So when you speak of repos, uh, practically, how do you speak of it? Who is the party who lends and who is the party who borrows? Like, so if when you say commercial bank, uh, went for a repo, how do you know whether commercial bank was lending or borrowing? Just in speaking terms.
So, okay. So the person who, so there are two. Okay. So on a, okay, the lender takes the repo. So basically he takes the security and lends out money. Okay. Whilst the borrower does a reverse repo. So he goes and pledges its securities as collateral and borrows money from the other end. So it depends on whether you're lending or borrowing. But in both cases, it's a collateralized lending and borrowing, where both parties agree on the security, the tenor, and the interest attached to the lending and borrowing. So in this particular case, with the central bank's involvement now, the central bank does not need to borrow money from anyone at any given time because it's the monetary authority. So they will be lending money to the market. But also, so the market will be borrowing money from the central bank. But as I told you earlier, if monetary policy needs to be tightened, then the roles are reversed. Even then, the central bank, even though they don't need money, they will mop up the liquidity in the market by borrowing from them. So they'll increase the interest rates that they give for these OMO repos and take in the money. And banks will happily give the money because rather than lending it to as assets, as credit assets, as housing loans, personal loans, all that kind of thing, they don't need to do that. There is no default risk involved, nothing like that. They can just go and give it to central bank and sort it out. Yeah.
Rashmin, so when the central bank does a repo, it increases the liquidity in the market. But when the bank does a repo, it increases the
Yeah.
bank's liquidity, right?
Central bank does a repo. What does central bank do? It gives out money to the bank, so that increases the liquidity, the interbank liquidity. Now, when the opposite happens, that is, the banks go and give their money to the central bank, that money, the quantum of money in the interbank market decreases. It shrinks. It comes into the central bank. Now, even though the central bank is a bank, it is not involved in lending, creating credit. That is, it only lends to banks, but it does not lend to individuals, right? So, yeah, so when a bank goes, when a bank goes and does a repo with the central bank, it will create a reduction in the liquidity in the system. And so that happens usually when monetary policy is getting tightened, when interest rates are going up. Okay. So any questions? No. So it's like this. So as I told you now, central bank does not create credit. It does not lend to individuals, but it only deals with banks. It either lends to banks or takes from banks. So when it lends to banks, the banks have more cash that increases their ability to create credit. So they can do two things. They have more money to lend to other banks or to lend to individuals like you or corporates. Now, when they lend to the central bank, they don't liquidity dries up. Why? Lower liquidity, and they have less money to lend to individuals and corporates. Now, from a balance sheet perspective, when a bank, because this is a repo, because this is a collateralized lending, can someone tell me when this bank lends to the central bank, what happens to the balance sheet? Something, this is not liquidity related. I'm asking about the balance sheet. What happens to the balance sheet? Can someone tell me?
The balance sheet of the bank, is it?
From the perspective of the bank. So I'm talking about the bank lending money to the central bank. Remember, this is a collateralized lending. So my question to you is, what happens to the balance sheet of the bank?
Your asset, security asset will go down and your loan asset will go up.
So are you sure? Why do you say the security asset? I mean, what do you mean by security asset, and why do you think it will go down?
If the bank is lending,
Money to central, yeah.
sorry, it will be
What
the
does
other
it?
way. Your
Yeah, exactly. So what happens? Just go through it.
you will get a security from the central
Yeah,
bank,
yeah.
and your securities on your balance sheet will go up,
Hmm.
and at the same time you're giving a loan, so which will mean your cash will go down.
Exactly. Simple as that, right? Did everybody understand this?
So that means there is no loan asset created, no? Because it's
So,
collateral.
so no, no, no. It's an asset because see, even whether it's irrespective whether it's secured or unsecured, an asset is created. It's an asset for the bank because it there is an interest rate attached to it. No? Did you understand it?
Yeah, okay, got it.
Right, right. So the balance sheet of the bank expands. Did you get it? The balance sheet expands. Both the asset and the liability side of the bank expands. Asset side expands because they created a lending with the central bank. Liability side increases because that security that they took as a collateral, it is security, but it is owned by central bank, so it will come as a liability. Now, when the central bank does this, it increases the liquidity or the money supply in the country. And this is why, I mean, when you read economic literature, you see central bank assets, central bank balance sheets increasing during periods of easy monetary policy. I don't know. I mean, if you read the Federal Reserve's papers and stuff like that, they will always say the Fed's balance sheet increased by this amount during these periods when Bernanke was easing interest rates, etc., etc. It's because of this. They are pumping out liquidity via repos and reverse repos and so on. Understood? Okay. Any questions? Because this is important, so you have to please clarify yourselves. Any questions?
So it's a bit unclear how the balance sheet expands.
So now balance sheet is made up of assets and liabilities.
Yeah.
Correct?
So when the balance
Now,
sheet expands, is it the sort of the net or just
no.
total of assets?
So both now asset, now let's say a commercial bank goes and lends money to the central bank. All right, 1 billion. So now on the asset side, it goes and gives money to central bank for 1 billion. So it will come as an asset. Liability side, you get a security from the central bank, a T-bill or a T-bond or a central bank security. There is another type called central bank securities. So that is also given. So that is equivalent to 1 billion. So the entire balance sheet of the bank increases by the same amount. Yeah.
Yeah, got it.
So when that reverses, central bank's balance sheet increases. Yes. Okay. Right. Any questions? All good? Right. Right. Now we talk about funding liquidity risk mitigating strategies. Asset securitization is a form of liquidity management carried out using asset sales, but different from the use of liquidity reserves. Using asset sales, but different from use of liquidity reserves. Securitization refers to the transformation of portfolios of on-balance sheet loans such as mortgages or credit card debt into securities that are sold to outside investors. So securitization refers to the transformation of portfolio of on-balance sheet loans such as mortgages or credit card debt into securities that are sold to outside investors. So let's take a look at how that works out. So let's take commercial bank again. Commercial bank on its loan book has 10 billion of leases. It has a 10 billion of leases. Now, this is an asset or a liability? Can someone answer that? Is it an asset or a liability? It's asset, very easy. So now, normally a lease is about 8 or 10 years in duration, time to maturity. So until the entire 8 or 10 years or whatever period is finished, all that money won't come back to you. And also during that time period, you are exposed to default risk, credit risk. Correct? Now, how do we, instead of wait until it matures naturally, is there any way we can expedite this process? How do we do that? So what we can do is we can take this 10 billion and we can sell it to someone else. Right. So 10 billion, we have created 10 billion of lease portfolio. So what are the advantages? So now let's take an individual. So 10 billion, someone who has 10 billion. So Hari Javardhana, Amika Pereira, or someone like that, a high net worth individual has 10 billion. And why do you think he would be interested in buying this lease book or the leases that commercial bank has with them? Can someone think of it and tell me? Why would he do it? Exactly. Yeah. So it's a good deal. Why? Bank has done all the hard work. Due diligence has been done. A commercial bank credit officers have scrutinized the salary statements and all that nonsense. So this is a functioning loan book. So he can take it. And he get on the plus side, he gets access to whatever, either whether it's a bank or a high net worth individual or whoever it is, gets access to a high yielding asset, right? It's not a low yielding asset, it's a high yielding asset. Now, from the bank's perspective, you don't need to wait till the entire time period is finished for these payments for the cash to come to you. So take 10 billion, even at a small haircut, they won't mind it, right? So if the bank 10 billion portfolio, even if the bank gets 909.5 billion, it's okay. Rather than waiting for 8 years to get that 10 billion, I will take 500 million, half a billion less. For Dhammika Pereira or let's say NDB Bank, whoever else who is buying it, you don't need to go through the hassle of advertising this, putting out marketing teams, due diligence, credit authorizations, all that nonsense. You don't need to go through it. So it's very easy. So did everybody understand this? How it works out?
Yes.
Yeah, all good? Right. The ladies are silent because I'm sure they understand. But you're welcome to ask questions if you have any. Okay, so let's continue. Right. And depending on the business model, securitization proceeds can be used for ongoing funding of a business line as a way to meet future funding needs. For example, a firm may view the potential securitization of a pool of mortgages as a method funding its origination of new mortgages or as a way to raise funds for the firm more generally. Right. Now, continuing, the next funding source is the issuance of debt obligations, which range from short-term repos or commercial paper to longer-term bank borrowings or bond issuances, which includes access to central bank liquidity facilities. This funding source is highly dependent on the firm's perceived financial condition. Hence, a firm's public credit standing, whether measured via a credit rating or the credit default swap market, is a key component of the firm's liquidity management system. Finally, the issuance of equity or related capital instruments is an established funding source. Right? So the other options are you issue debt. So what do you mean by debt? Bill, debentures, corporate debt, commercial paper, whatever. And the other way is to issue equity. Okay. The central objective of a liquidity risk management system should be to ensure with a high degree of confidence that the firm is in a position both to address its daily liquidity obligations and to withstand a period of liquidity stress. So two things. Daily liquidity obligations. So the normal ins and outs that a bank has to face. Any bank has to face deposit, withdrawals and deposits, right? So that is what we are talking about here, the daily liquidity obligations. A period of liquidity stress. During periods of liquidity stress, that is the more important thing, whether firm specific or market wide. A key component of this system is a firm's liquidity risk tolerance, which is the level of liquidity risk that the bank is willing to assume. There are several ways to express this risk tolerance, such as the percentage of total debt obligations not fully funded at a point in time. The tolerance should be appropriate for the firm's business strategy, strategic direction, and overall risk appetite. The firm's board of directors should be responsible for setting and monitoring the firm's liquidity risk tolerance. Okay. So this strategy should include specific policies on such issues as the composition of assets and liabilities, especially regarding maturity and the diversity and stability of funding sources. Okay. So first is would include specific policies on such issues as the composition of assets and liabilities, especially regarding maturity and the diversity and stability of funding sources. So what does this mean? It means that basically when you lend out, you should be aware of the tenor that you lend out in relation to not only the profitability of the lending, but also in relation to the deposits that you have raised. And as well as to look at the stability and diversity of funding sources. So you can't be dependent only on your fixed deposits or the CASA balances. CASA meaning current accounts and savings accounts. Because current accounts and savings accounts, by definition, by legal definition, can be withdrawn without any notice. At least with FD, you can charge the customer penalty interest, right? That is there. But with what do you call these savings accounts, it can go away tomorrow. Nothing there, no? So what do you do? So that's the problem. Strategy must be communicated to all businesses, to all business units that have an impact on the firm's liquidity position. In particular, liquidity costs and risks should be incorporated into both on and off balance sheet product pricing. This approach should align the risk-taking incentives of individual business units with the liquidity risk their activities create for the entire firm. Okay. So all good. The goal of liquidity risk management, the goal of liquidity risk. Yeah, tell me.
Sorry, on the
Hello?
previous, hello,
Yeah, tell me.
on the previous slide, so why is it important on the diversity of funding sources?
Yeah, so that's what I told now. If you depend only on your deposits, that is normal CASA balances, CASA meaning current account and savings accounts and fixed deposits, okay, only on those, there is no, you're tied down, you're hampered by this, right? But if you are more diverse, if the kind of if access to these are diverse, so for example, if you have central bank ability to access the central bank, or you have the ability to access the debenture market, corporate debt market, I don't know, this interbank borrowings, so on and so forth, that's a good thing, because you know then that even if the deposits go away, even if there is a for some reason there is a sudden demand withdrawal of deposits, no problem. We can go and borrow from the central bank. Go borrow from other banks. So that's what I meant by the diversity of funding sources.
Okay. And the stability is that those funding sources should be available throughout.
Exactly. Yeah, consistently, because you can't be dependent. You can't just take their word, right? If they just give a word saying, no, don't worry, we'll be there for you, but the next day they disappear, what's the point? Right? So, okay.
Yeah, thanks.
Understood? Any other questions? No questions? Okay, that's fine. Right. So, early warning indicators, standard tools in liquidity risk management are early warning indicators to identify vulnerabilities, rapid asset growth in a business line, decreasing weighted average maturity of liabilities, additional counterparty requests for collateral. So, can someone tell me what this one means? Rapid assets growth in a business line. Any answers for this? What does this mean?
High growth in the lending portfolio.
Exactly, simple as that. So, high growth in the lending portfolio means that lending is increasing fast. So, that means your money or liquidity is getting drained. The second one, decreasing weighted average maturity of liabilities. What does that mean? Any idea? Any answers? Any answers, please? So basically, the the deposits are being open short tenor. Short tenor deposits. So when it is short tenor, short dated, what happens? The depositors can ask their money back at a faster rate, and in a faster rate or sooner. Okay. Any questions? No questions? Right. So no questions at all? Right. Okay. So let's go to the next slide. Stress testing. Stress tests should be conducted regularly for several firm-specific and market-wide stress scenarios with the goal of identifying sources of potential liquidity strain. Stress test outcomes can be used for adjusting business exposures, liquidity buffers, and possibly even the firm's risk tolerance. Range of stress environments, including clear lines of management responsibility. Yeah, go ahead. Okay, one second. Now, can you see it? Yeah, you can see
Yeah,
it now, right? Yeah.
Yeah.
So, stress tests should be conducted regularly for firm-specific and market-wide scenarios with the goal of identifying sources of potential liquidity strain. Stress test outcomes can be used for adjusting business exposures, liquidity buffers, and possibly even the firm's risk tolerance. The results of stress tests should also play a key role in shaping the bank's contingency funding plan, which is the firm's policies and procedures for responding to liquidity disruptions. A CF contingency funding plan should outline how the firm intends to manage a range of stress environments, including clear lines of management responsibility. Okay. So, any questions? No questions? Yeah. Yeah, it's simple. So now what have I said here? Several firm specific and market wide stress scenarios. So firm specific, now let's assume that we have a 1 billion loan book, deposit book. So we can assume that if there is a 50% withdrawal of the deposits, what happens? So we have to understand how will we fund the shortfall in that situation. Or if there is a 100% withdrawal or 75% withdrawal, who do we go and approach to get cash, right? Right. And also now those are firm specific. Now if there are certain products, different products that they raise, uh, they have they have long dated deposits, so hopefully those deposits will not get withdrawn very soon, or they have very short dated deposits with no penalty interest if you uh, withdraw them. So on and so forth. Now if you look at the lending side, um, what is the mix? Is it long term lendings or short term lendings? So that is all firm specific. Now coming, the next thing is the market wide stress test. So on a market wide basis, is liquidity going to improve as you take, if you take the entire market, will liquidity improve in the following days, or if there's a sudden decrease in liquidity in the entire market, you know so on and so forth. Okay. Right. So any questions? No questions? Okay. So if you guys, if you don't have any questions, I will stop here.
Sorry, Rashmin.
Yeah.
This
Tell
is
me.
on the previous slide that the counterparty additional collateral request. So this is basically when the bank wants to borrow, the counterparties ask for more collateral. Is it?
Exactly. Correct. So that. So when that happens, that means your access to liquidity is lower, right?
Yeah.
Hmm? Okay. Right. So if there are no other questions, I'll stop here. Okay. All right then. Have a great evening. Bye.
Thank you.
Thank you.
Bye bye.
Thank you, sir.